And now it's time for Ag on 8, where we share ag news impacting you. Well, here locally in the last week, a barn fire broke out on 195th Street in Bettendorf. The streets surrounding the area were blocked off as the large barn was seen with smoke rising from the roof. You can see it here on your screen. In that pole barn, there was hay and there was machinery, and the owners weren't home when the fire started. They did later confirm there wasn't any livestock inside the barn. No civilians or firefighters were injured, and the cause of that fire remains under investigation. The United States Department of Agriculture is expanding crop insurance access, and this includes changes to the Prevent Plant program. This program is a classification of land where farmers can buy special coverage if after a certain date they can't grow a crop because of severe weather. The USDA changes also make it easier for farmers to report their yields if they're switching to a new crop insurance provider. And if you're a farmer on either side of the river and you want to save money on crop insurance, you better listen up. In Iowa, farmers who plant cover crops can enroll in the crop insurance discount program. Enrollment opened last week, and it gives farmers about $5 per acre towards their crop insurance premiums. The program is a piece of Iowa's nutrient reduction strategy, and over in Illinois, there's a similar program. Their pre-enrollment is open now, and full enrollment starts on December 15th. Well, a major railroad wants the federal government to take another look at a 1996 rail merger. Back in the 1990s, Union Pacific and Southern Pacific railroads merged, and that deal gave another railway, BNSF, certain rights that were supposed to protect competition. Well, now BNSF says that Union Pacific isn't living up to that agreement. It's all relevant because Union Pacific is also trying to merge with Norfolk Southern, and one of those rail lines runs right through Clinton, Iowa. BNSF says that this review would let regulators look at how that old merger worked out. That's before they sign off on any new ones. Well, the Trump administration is proposing a change that could impact the cars that you buy. In 2024, the Biden administration raised corporate average fuel economy, or CAFE standards, and it required new vehicles to average higher miles per gallon. But now the Trump administration is rolling them back, saying it could save Americans money and give you more choices when buying a car. I caught up with Rod Weinzierl, the executive director of the Illinois Corn Growers Association, and he breaks down how it could impact drivers and farmers in our area. Okay, Rod, take us back to 2024 when these initial standards were changed. What did this do overall?
Well, initially, some of these standards changed back in '09. They were a little bit changed in the first term of the Trump administration, and then when President Biden was elected, he came in and went back, kind of started with the '09 standards, but actually even accelerated them. So what these standards do is set what the future mileage of the vehicle fleet that is sold every year should be by car manufacturers, and the car manufacturers have to hit that mileage or they are penalized in that process. What this administration has done is the mileage is still going to increase with the future car fleet, but it is going to increase at a slower rate. And then there's a couple other things that were changed within that.
And back in 2024, there were some implications with electric vehicles. Can you explain that?
So one thing that President Biden did with his update in 2024 is they entered electric vehicles. Okay, so mileage was always previous to that around fuels or cars that used a liquid fuel, and they modified the rule to count electric cars. Well, within the scope of these regulations, electric cars would get the equivalent of like 320 miles per gallon, versus that same car on an internal combustion engine would maybe get like 35, 36, 37 miles. And by accelerating the mileage in CAFE to the level that the manufacturers were going to be regulated, it would have caused by 2032, 67% of all new cars being sold be required to be electric. That's how steep this curve was. And what this administration has done is still have an upward slope of mileage increasing every year, but slowed that down so it didn't create a de facto electric vehicle mandate.
And if I'm someone that's wanting to buy a vehicle, what does this change in the past week mean for me?
Well, what we've seen is, and we represent farmers, right? So a lot of farmers need pickups that help them do their job, help them work, not necessarily just get maybe an average consumer to and from work. And the cost of pickups have gone up probably astronomical due to this because the way this regulation works is it causes the vehicles that can't meet those mileage, the price to go up and up and up and up, which then creates a de facto kind of credit for those vehicles that get the super great mileage, like 300 plus miles per gallon, like an electric vehicle. So what you should see is the vehicles that consumers are more interested in buying be some relaxing of price over time. Now, it might take a couple of years to kind of work through that, but you should see the normal vehicles kind of deflate in price because this regulation was causing that to happen.
And I know as a farmer group, you're also invested in this discussion because of ethanol. What were your worries back in 2024 or 2009, even going back that far?
So the challenge is obviously ethanol is blended with gasoline. And so as gasoline sales go up or go down, our ingredient, ethanol, goes up and down. We would have seen probably around a billion bushel loss market as we went into the early 2030s. So that is significant of a market loss. And our only real way of trying to navigate that is to increase the amount of ethanol in that given gallon or get more tank space, as we like to call it, to be able to offset that, which is weird because the past administration, their EPA, they didn't want to see that either. Okay, so their goal really was about how do we electrify the entire transportation network, and it's most easily done in light duty vehicles, which are the cars and pickups that farm families buy, and the regular consumer, not necessarily the heavy duty pickups or like semis and things like that.
I know the corn growers have been active in a number of legal battles because of standards like these. Does this standard, this reset by the White House in the past week, in some of those fights, or you still have issues that you're worried about right now?
Well, so this is just a proposed standard, right? And so this is open for comment, and we'll kind of see how this goes. The challenge that we see as someone that participates in this marketplace from in this case, a fuel supplier, not quote the oil company, but an ingredient. The challenge is each administration seems to be kind of oscillating this back and forth, right? And even the auto industry, you know, there for the last few years, it's like, hey, we need more factories that can build electric vehicles. Well, now they have to kind of go backwards and go the other way. And depending on what happens in 2028, do they have to flip and go the other way? So it creates tremendous inefficiencies in the overall economy. And so ultimately, the investors or owners of auto stock get whipsawed, consumers get whipsawed, and we really need Congress to actually kind of say, hey, this is what we want to do over the next 2 or 3 decades, and actually pass laws that kind of better guide what future administrations and future agency leadership can do so that they have to stay within a parameter instead of going 180 this way and totally reversing and go the opposite way. We'd all be better off.
Yeah, it sounds like a lot of back and forth. I have to ask, because we have a lot of corn farmers in our area, overall, where is the ethanol industry headed in the next 10 years?
Well, the domestic ethanol industry right now, we are in downcline, right? So electric vehicles are selling. There was a lot of incentives recently. Some of those have come back, but we also recognize that there's a lot of households out there, especially in larger metropolitan areas, where if they have 2 or 3 cars in the family, that one of those cars, an electric vehicle might make sense, right? Whether it's the spouse getting to work and not having to worry about filling up with gas, if they have kids that have a driver's license, maybe they don't want to give them a credit card for gas. They can just give them the keys to the car to get back and forth. And so, we see that we will have a continued erosion of overall liquid fuels. I mean, it's technology, but what we want is kind of like a technology neutral platform where we set our goals, we try and increase mileage, we work on better environmental outcomes, so that all technologies have the ability to participate in that. And what's frustrating is, a car that can run on 85% ethanol in some cases is actually cleaner than an electric vehicle in some parts of the country because of the electric grid. But there's no opportunity for other technologies, other fuels to participate in the overall goal versus trying to pick one technology that one administration wants and another technology that the next administration wants.
Well, Rod, thanks for giving us your thoughts today. We appreciate it. Well, that wraps up Ag on 8 for today. Thanks for joining us. We'll see you back here next week.